Okay, brilliant. Right, I think we've got most people logged in now. So good morning, everyone, and thank you for joining our webinar on preparing for the sale of your agency. My name is Esther Carter, and I'll be chairing today's session. Many of you do know as well already, there's lots of familiar names on the attendee list, but for those of you who don't, Moore Kingston Smith are a top 15 audit, tax and advisory firm. We've got 6 offices in London and the South East, and we're also part of More Global, which is an international network with presence in over 100 countries, which enables us to support our increasingly international client base in a very joined up way. I head up our media division from our West End office, where we have a team of 90 that work purely with marketing services, film, TV, theatre and media tech companies. And that ranges right across from startups right through to sort of multinational private equity backed firms and AIM listed groups. Now, media has always been particularly active in the M&A space, and most of my clients have got some aspiration to sell at some point, whether that's to a WPP or one of the big consulting groups like Accenture, or maybe to one of the UK sort of private equity backed buy and build groups. And we can help prepare them for that time, making sure that they maximise their exit value, as well as actually finding them a buyer and taking them right through the sales process. As you can imagine, activity quietened quite a bit during the height of the pandemic, but it has picked up since then. There's quite a lot of pent-up demand to buy, particularly from some of the private equity houses, and we've seen a big uptick in activity there, as well as quite a lot of pent-up demand to sell as well, of everyone sort of, well, a lot of people having one eye, of course, on the potential capital gains tax changes that we thought might come in this year that may come in next year. We'll talk a bit more about that later. So we've got about an hour this morning. We're going to spend 15 or 20 minutes talking about the current M&A landscape within the sector, and also looking at what a typical deal process looks and feels like. And then we'll spend the rest of the session discussing just some of the sort of common issues and questions that come up when people are planning for that exit and going through that sales process. So I'm delighted to have on the panel today Paul Winterflood, who's one of our corporate finance partners, Dan Lehman, who's one of our corporate finance directors, and Mike Hayes, who's one of our tax partners, all of whom have enormous experience in advising on corporate finance transactions, particularly in the M&A space, having advised on around 17 transactions last year in the marketing, services and media sectors alone, including the sale of Synergy, an employee engagement company, to IPG. There will be time for questions at the end, but please do put questions into the Q&A function, not the chat function. Please do put it in a Q&A function, much easier to track there as we go through, and I'll aim to put some of those questions to the panellists as we go through this morning. So I will firstly hand over to Paul then to give us an overview of the M&A landscape. Paul.
Thanks, Esther. Morning, everyone. So for the first 5-10 minutes, I'm going to provide an overview of the media and Marcom's M&A landscape, reviewing Q1 of 2021, and as well as looking at some of the trends and the outlook ahead. So I'm just going to share some slides. So for those of you who haven't joined one of these seminars before, at Moore Kingston Smith, we track deals involving UK companies throughout the media and marketing services sectors, and produce quarterly reports analysing the activity and some of the trends. In the February webinar, when we were reviewing 2020 activity, we were predicting another quarter of recovery, and that was certainly the case, as you can see here. There were 53 deals that we recorded in Q1. That was a very early run of the numbers. That may increase a little bit further, but we're showing quarter on quarter growth. The numbers are still significantly below the 2019 levels, but things are definitely heading in the right direction, which is very positive news. Going into Q2, there's certainly a decent level of activity going on at the moment still. I would expect the next 2 quarters to be similar to Q1. They're traditionally quieter quarters for deal completions, but then I expect that the final quarter of 2021 and the first quarter of 2022, particularly if there's more rumblings around CGT, which Mike will touch on later, I expect them to be bumper quarters. So from a seller's perspective, it may well be wise to get ahead of this wave if possible. So a trend of the last few years, and indeed from the 2020 review, was that private equity-backed acquirers are becoming increasingly prominent. And this quarter blew all the previous ones out of the water, with 66% of deals having private equity involvement. I think this is possibly a slight anomaly in terms of the percentage. I think that PE houses absolutely have to deploy capital, and so they're able to deploy capital and are probably looking to deploy capital when times are slightly more uncertain, whereas corporate acquirers are generally more conservative in uncertain times. However, I would expect the volume to hold or to increase as new PE houses are continuing to invest in the space, which is great news for acquisition activity over the next few years, particularly if some of the more corporate acquirers return to the fold too. In recent weeks, a couple of PE-backed transactions to draw your attention to. Bridgepoint invested in a Leeds-based digital agency called IDHL, and earlier this month, in a deal which actually slipped into Q2, Horizon Capital invested in B2B Specialist, the marketing practice. Both of these investments were to deploy a buy and build strategy. So I think they'll both be 2 names to watch out for on the acquirer lists as we move forward into future reviews. In terms of skill sets now, digital, as you'd expect, was far and away the most sought after. I think the thing to note here, though, is generally when we track these numbers historically, the digital acquisitions make up around 50% of the deal numbers. However, in this quarter it was 75%, and probably that's a consequence of a couple of factors. Firstly, agencies with digital capabilities have generally performed exceptionally well over the past 12 months. And I'd probably say the second factor is that PE houses are making digital capabilities the cornerstones of their acquisition strategies. So both of those factors driving that trend. When we then look at the further in terms of the digital capabilities, analysing it into the various digital subsectors, we can see a couple of interesting trends here as well. So firstly, full service digital is always pretty well sought after, and they always make up a decent number of the deal of the digital transactions. So here there was 25% in the last quarter. Probably more interestingly is around the specific capabilities. So the second one here is data and analytics. Over the last 5-6 years, digital analytics capabilities have been long sought after by acquirers, but that's been more of an aspirational goal. The scarcity of the skill set has meant that the number of data and analytics acquisitions really didn't reflect the level of demand, but the deals in quarter one suggested that this may no longer be the case. The second trend, I'd say, is around social influencer and content. Again, they made up a decent proportion of the digital acquisitions. I'd probably say the deal that raised the most eyebrows here was the purchase of influencer marketing business Goat by private equity house Inflection. Influencer businesses have long attracted the interest of VC houses, and there's been a fair amount of speculation about which mid-market PE houses would start to take the plunge into the influencer marketing space. So I would expect that Inflection won't be the last one to acquire in the space. Finally, just looking at some of the specific acquirers here, Bridgepoint and Inflection, we've already mentioned, but Goat and IDHL are definitely, as well as the marketing practice, are definitely acquirers to watch in the future. Selby Anderson have consistently been, I think they've acquired over 4 agencies a year for the last couple of years, and have started this year acquiring another 2. So definitely a group to watch out for. But by far and away, possibly the standout acquirer this quarter were Jellyfish. They made 5 acquisitions, all announced on the same day, which helped them expand their global footprints into South America, Australia, and further into Europe. The acquisitions all have data and analytics capabilities, underline the trend we mentioned earlier, with offerings in e-commerce, content creation, creative, and localization. So I think all in all, it's a very really interesting market at the moment. I think the summary is that the market is definitely still recovering. We've still got quite a way to go to get back to the 2019 levels. What we saw last year was that there was more of a supply side problem, as a lot of agencies decided that 2020 wasn't the year to sell their agency, and we're starting to see activity levels increase. I think the late part of this year we expect it to be exceptionally busy, as people that have delayed their sales will start coming to market. We've got the CGT, expected changes to capital gains tax, which will impact the market as well. And then finally, from the buyer's perspective, the level of private equity interest means that the sector is very, very strong, and we expect it to continue to be strong for a number of years, particularly because new houses are coming to the sector all the time. I think agencies with the right proposition, it's a great time to be selling, and I would expect the deal numbers to keep trending up. So now I'm going to hand over to Dan, who's going to talk you through a typical sale process.
Thank you, Paul. So we thought it would be quite useful now just to briefly recap on a typical sales process, the times involved to achieve a sale process, and the kind of fundamental steps and stages that we go through. Like everything, we start off with a preparation. And this really is one of the most important stages of the process, because this is where we're going to create the materials and look in depth at the numbers that we'll be presenting to potential buyers, together with unique selling points, and really trying to get under the skin of your proposition to make it stand out when we're selling you. The process ends by preparing a information memorandum. Normally we also will prepare a summary document, a teaser document, which is a couple of pages. We'll also research potential buyers, focusing on people we know are buying, such as the private equity houses, the sponsored trade buyers, but also the trade buyers who we know are active, as well as other people who might have a strategic reason to look at your business. But we don't go to everyone, and it's not a process of just sort of scattergunning the market. We'll agree with you a tailored shortlist, and then we'll be ready to go to the next stage. The key, though, in the preparation at the moment is going to be a few things. Firstly, it's going to be to identify the impact of the pandemic on your business and to try and understand what the underlying sustainable business results are after you take out the impacts of the coronavirus. And there obviously needs to be a fair bit of work on that, looking at furlough claims that may have been done, lost income that's coming back, etc., etc. We also need to obviously establish one-off or exceptional costs that are going to be added back when we present your results, because they won't recur in the future, to give a sort of normalized EBITDA performance metric, which is earnings before interest, tax, depreciation and amortization, and potentially also coronavirus, and we can call it EBITDAC. The other thing that's really important is being upfront about any issues that are within the business, because as you'll see later on, there's a due diligence phase where these issues will probably come out if you try and hide them. So much better to deal with them upfront and put any mitigants in there in the documentation, as well as the opportunities. And then really, it's all about selling the future. People do not buy the past of an agency, they actually buy what it's going to do in the future. So really getting under the skin of your forecasts and selling those as part of the documentation is key. But it's a balancing act, because they need to be really robust and credible, because you're going to have to deliver against them throughout the process and then into the future. The marketing phase is one where we're quite uniquely placed, because we have quite a lot of industry contacts across the sector. So we normally are able to approach decision makers quite easily in the acquisitive groups and private equity houses, but we are also obviously able to contact others as well. We do that process on a confidential basis using non-disclosure agreements, and we'll negotiate those on your behalf, and then we'll distribute information memorandum to interested parties before hopefully setting up meetings and site visits and presentations. The key here is actually just keeping control of the process and quickly trying to get a view of who are the real interested parties and who are might just be looking out of curiosity, and closing those ones down quickly. Obviously, we invite offers. This stage is a really, again, a detail-heavy stage, because the devil is always in the details on those offers, and actually modelling out, given the complexity of offers that are nowadays received with very different earn-out mechanisms and working capital adjustments and what have you, that what each offer really means in cash terms and timing terms is very important, as well as ensuring obviously the tax structuring of any offers and understanding what it means to the shareholders in terms of take-home cash. And we'll help you through that process before you can finally agree heads of agreement with a specific buyer. At that point, normally there's exclusivity granted to that buyer to enter due diligence, and a due diligence process starts. Again, very often that will start with us helping you pull together a data room, often nowadays a virtual data room, where all the documentation is stored and access is controlled and logged. The types of due diligence that are undertaken, there's normally financial due diligence, there's always legal due diligence to some extent, and often there's commercial due diligence as well, where they'll be looking at just the sort of commercial offering. The key of this process is actually to be prepared in advance so that it can run smoothly, all the information can be available as required, and that if any questions do come up, we're ready with answers. If there are issues that come out of due diligence, that can often lead to further negotiations, and how they're managed is often something that we will get involved with as well as the lawyers, to try and find ways to give comfort to potential buyers on those issues whilst protecting sellers' positions as much as we can. Here again, in that process, we will try and establish a normalised working capital position with whoever's doing the due diligence to ensure that the maximum extraction of excess working capital can be added to the purchase price for the seller, which can in many cases actually be quite a significant amount of additional consideration. And then finally, the legals and completion stage is where the share purchase agreement's drawn up. The key things often here are probably the definitions of the again, the excess working capital position, but also around the earn-out element of any consideration, ensuring that those are drafted in such a way that maximises sellers' chances of the most consideration. There's also things to consider like the warranties, where representations will be made and negotiations around that. There may well be completion accounts to help with the working capital adjustments, and then as many protections as we can put within the documentation to protect that deferred consideration and earn out for the future. So that's a typical process. The key thing in the process is the length of time it takes, and people are often surprised at how long this takes. I mean, as you'll see here, you've got roughly a 6-month process there, and that is a process that's running smoothly. There are many processes that run longer than that. So for people who are wanting to sell potentially before the end of the tax year, in sort of March next year, you'd want to be starting preparation probably before the summer, and going to market as soon as possible afterwards. So yeah, that's the process. And now I will hand back over to Esther to chair the Q&A.
That's great. Thank you very much, Dan. So if everyone can put their cameras on, Mike can finally reveal himself. We'll open up the Q&A session. We've got some questions of our own. Some have been pre-submitted, some are just questions that we know everyone probably wants to know the answer to. But I see the Q&A function is currently empty, so anyone who has got questions, please do pop them in there. So I'm going to start with you, Mike, because I know everyone's interested in tax. So what is your crystal ball? What is going to happen next year with CGT rates?
I cannot believe there is not going to be a change in capital gains tax in the next year or so, which is going to make the position worse. I mean, we've got the lowest capital gains tax rate since the tax was introduced in 1965, I think. So it's something I think is bound to happen. We are due a budget in November. Typically, capital gains tax changes apply from the beginning of a tax year. So, you know, if Rishi announces something in November, you would expect it to apply from April 2022. But it could apply from, you know, the day before budget day. So, you know, if you're going through the thoughts of actually selling, or you're starting the process, I think there's a lot to be said for actually getting it done before the end of October, because of that.
Yeah, and also obviously, given that Dan said the process can take quite a while, thinking about when one might start that process to make sure you get it done by then. And I mean, Mike, you know, what can people do to improve their capital gains tax position? Is there anything people should be thinking about right now?
Well, there's a few things. Firstly, there is what used to be called entrepreneurs relief. It's now called business asset disposal relief, which gives you a 10% tax rate. I mean, that's only available on gains of up to £1 million now. It used to be £10 million until about a year ago. So making sure you qualify for that. So you have to be a wholly trading company. So if you've got significant investments, you know, that might be an issue, might disqualify you. So looking at that would be worth doing. Also, of course, if it's possible to bring in other family members in as shareholders. You know, it's a £1 million 10% limit for everyone. So if you can bring your spouse in as a 5% shareholder, and make them an officer or an employee, they have to wait for 2 years, but that potentially makes another £1 million of the 10% tax rate available. And the final thing I would actually say is a little bit tangential, is to make sure that your company contains only assets that the buyer wants to buy. So typically buyers will not want to buy properties, freehold properties, and taking those out of a company immediately prior to a sale can be very expensive, because you could end up with income tax and a capital gain in the company. But if you plan well ahead, it is possible to extract assets like that tax effectively, but that can't be done the day before a sale, or a week before a sale, or even a month before a sale. So making sure you've got your company tidy and that it contains the assets that the buyer is likely to want to buy is really important.
I think that's right. I think the message here, when it comes to either tax planning or just generally planning for a sale, is to make sure that you are thinking about it a good sort of couple of years ahead from when you think a sale might complete, and speaking to professionals like ourselves, obviously, for example, about what one needs to get sorted before that event happens.
Yeah, it's definitely nothing more frustrating than speaking to an agency that want to sell and want to sell now, and being able to with easy fixes that if we'd have been speaking to them 6 months before, we could have identified and help increase the value.
That's right. I mean, the sales process is time consuming and distracting enough for the key leaders of the business, without also trying to fix lots of problems that could have been fixed well in advance. So Paul, staying with you then, I mean, obviously pandemic last year, I mean, how much has this affected company valuation? Should people be worried that it's affected the long-term prospects for their exit value and their retirement pot?
I'd say from what we've seen, the coronavirus has had no impact on valuations and multiples, but as ever, it always comes down to the merits of the target business. If you have an agency that is sellable, you will, from what we've seen, you'll be able to attract the same multiple that you would have been able to do in 2019. If anything, in some instances, the lack of opportunities coming to market meant that there was a bit of multiple inflation, as the buyers were fighting over a very finite number of assets. I think conversely as well, if you've spoken to us 12 months ago, all of our opinions were that there was going to be a wave of businesses and agencies coming to market looking for a safe home. However, thanks to the level of government support, there just hasn't been any distressed M&A activity really. So all very positive. As I mentioned in the M&A review, we are expecting the market to get very busy towards the end of this year, and depending on when the expectation is that CGT changes will kick in. If there's a lot of agencies coming to market, it may quickly shift into a buyer's market very quickly, and that'll be particularly problematic where an agency has maybe an undifferentiated proposition. Agencies with high quality propositions will always be very highly sought after. I think the other thing to mention as well in terms of the impact on pricing is around the 2020 profitability. This is going to be a bit of a minefield, whether your results were positive or negative. I think for people, businesses in all sectors, margins have increased in 2020 because of the lack of travel, entertainment. People have been able to use the furlough scheme for non-utilised staff. So certainly from the KPI analysis in the annual survey that we've done, margins have been increasing, but buyers are definitely wise to it, and they'll be looking to isolate and the sort of the long-term profitability. So I think it's definitely worth considering when you're looking at your 2020 numbers, how sustainable are your numbers, and how can we justify that those numbers are sustainable? Because that will absolutely be something that buyers will be looking at very, 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 very carefully.
Yeah, definitely. I certainly got clients who are still benefiting from all the cost cutting, but how long that will last, we don't know. And what about deal structures? I mean, the question I get asked an awful lot is, what does a typical deal structure look like? And quite frankly, how much cash am I going to get on day one, and how much am I going to have to wait for, and how long am I going to have to wait for it?
So I'd say the rule of thumb is that you can expect between 40 and 50% of cash to be delivered upfront, with the remainder to be delivered across an earn-out. Probably average length for an earn-out on initial offers is probably 4 years. Normally we can. Sorry, there's building work in the background. Normally we can negotiate it down by at least a year. In some instances, we've been able to get earn-out periods down to as low as 1 year. But I think as a seller, your expectation should be a 3-year earn-out and between 40 and 50% of consideration upfront. Where that can be lower is if there are risks. For instance, if the acquirer has doubts about whether the founder is going to stay in the business post completion, if the financials in the completion year are maybe potentially could be an anomaly, or if there are other issues such as client concentration, then that can reduce the amount that a buyer may be willing to pay up front. But equally, as a seller, you can see that as an opportunity. The more that you can pay through the earn-out, if this is a buyer with lots of synergies and a great cultural fit, which is what we're trying to find through any sale process, then that can absolutely get to a situation where you can have a bumper earn-out, and you get to you've seen the dream headlines for a few years ago with the Adam and Eve deal. That's when things go absolutely right for a seller.
Yeah, and we've got a question coming here for you, Paul, around, you said people are buying the future, not the past, and therefore sort of the old rule of thumb of, take an average of the last 3 years, is that not applicable? But I think what we're saying is you get some of that now, but you get the rest of it based on the future profitability.
Yeah, absolutely. I think probably the average of what we see at the moment is particularly with PE-backed acquirers, it tends to, the earn-out payment tends to be, or the amount you get, your final price that you receive for your agency is typically an average of now until the end of the earn-out period times by a multiple based on the levels of growth you achieve.
But the upfront bit is likely to be informed by maybe a little bit of the recent past.
Yes, it's likely to be informed by the recent past, but that's only a down payment. The actual amount that you receive overall is based on the earn-out.
And I mean that sort of links into another question that came in actually around private equity firms, in terms of do we get a higher multiple from a private equity firm? Are the values higher than the groups, the internet, the sort of the WPPs and the Omnicoms?
No, I wouldn't say. For what we've seen, PE-backed acquirers and PE houses, they're financial, they're investors at the end of the day. They're not going to pay over the odds. They'll be paying what they believe is market rate and what they believe that what growth they can get through the business over the 3 to 5 year period that they own it. It's all about scalability. That when you see the S4, for instance, have bought some businesses at 15x, but that is all down to the fact that they firmly believe that they can scale the business and its very unique digital capabilities, and it's that combination which will drive value to the shareholder base. Yeah,
brilliant. Thanks, Paul. Dan, maybe a question for you. Somebody said they've built up a lot of cash reserves throughout the life of the business, and they're thinking of selling, and what should they be doing to ensure that they maximize the value of these cash reserves? And that also sort of ties into another question we've had around, as a rule of thumb, how much working capital generally should be left in a business in terms of sort of how many months worth of overheads?
Okay, I mean this is often where a lot of work is done, and a lot of detailed analysis can be applied to make sure that we try and maximize those things. But as a rule of thumb, a business is sold cash-free and debt-free. And what that actually means is if there is excess cash, we can increase the price for it and ask the buyer to pay extra for that, which is tax efficient often. But equally, if there's debt in the business, that will reduce the price and likewise. And so a lot comes down to, yes, what is this working capital number? We normally typically say that it's 3 months worth of overheads in working capital. However, different businesses may have different working capital cycles, and we can look into that. And if we can prove that the business has a genuinely lower working capital requirement, then that's obviously worthwhile work, because the more you can minimise that requirement, the more you can take off the table at the point of sale. So there are typical things, but again, the devil comes in the detail, and looking at the individual cash flows of the business. You can get some very cash flow positive businesses where they're receiving payments up front at the beginning of projects, and typically have a much lower working capital requirement, and even businesses with almost a negative working capital requirement, because the trading actually is that cash flow positive. So yes, there are typical things, but I think it's worth looking at each individual business and trying to do that analysis, and then take as much cash off the table as possible. And does that answer the question?
Yeah, I think it answers most of it. Yeah, I mean, 2 to 3 months is a good rule of thumb, but definitely I have seen where we started with at that point, and then you guys have come in and gone back 24 months, looked at the month-on-month cash flows, the working capital requirements, the bank balances, the debtors, the creditors. Actually, we've been able to extract much more surplus working capital on the deal than was originally thought. So it's definitely worth doing that more detailed exercise, because actually some of these working capital adjustments to the value, they can actually be pretty chunky and form quite a significant part of the deal.
They can pay all the professional fees for the whole transaction and more sometimes. So just the work on that alone can easily be worthwhile. Yeah,
and Mike, I guess it's worth just bringing you in on the tax treatment of those surplus working capital adjustments.
Yes, surplus working capital adjustments will simply get added to the proceeds that you receive in the year of sale. So it's just additional share consideration. The only thing I would just throw into the pot there is that if you're a company that's got share options in place, when those share options are exercised, the difference between the price paid and the sale price, the company's entitled to a corporation tax deduction for that. So one point that we would always seek to negotiate is that the corporation tax saving that arises because an option or options are exercised immediately before a sale, that reduction in the tax liability should be added to the working capital adjustment and give additional proceeds. Now, not all buyers accept that, or they don't accept it without a bit of beating about the head. But it is an important point, because it could be, if you're granting options where the option price is a nominal amount and the sale price is much higher, that deduction could be quite significant. It could amount to hundreds of thousands of pounds.
Yeah, it can do, and I think we do beat people around the head with it, and we normally win the argument. I think what normally happens is they say that you can have the cash that relates to the Part 12 deduction as and when the tax, the reduction of the corporation tax liability falls due. So you might have to wait for it a bit, but you do actually end up getting it. I mean, that's a good point though, Mike, to mention share options, because I think we spend an awful lot of time putting in EMI schemes for our clients, and I think it is a really important part of the planning process for sale. I mean, Dan, Paul, I don't know which one of you wants to pick it up, but I mean, how important is it to have your senior leadership team incentivised with equity in terms of making yourself attractive to a buyer?
I think it's absolutely.
You go, Paul.
I think it's absolutely key. That I'd say the number one reason why agencies fail to sell is if the acquirer doesn't believe that the goodwill is staying within the business post deal completion. So what I mean by that is that they just think the founder shareholder will get their money and run. So having an incentivized second tier management team that you can demonstrate own the client relationships, run the business, and importantly, are incentivized to stay through the earn-out. That is exactly what an acquirer is looking for. I think it's also, with the incentivization point, it's also one of the things I was alluding to earlier around if you can speak to advisors earlier, then it saves money and protects value. There was a transaction that Mike and I worked on a few years ago where they wanted to put in place some share options, but this was after they had got an offer from a potential acquirer. The impact was they probably lost about £250,000 in tax versus if they'd have put that incentive plan in place before the offer has come in. So it's well worth thinking about that kind of thing well in advance of a sale process. It's never too early to start thinking about it, because you don't know when someone may approach you to talk about potential acquisition.
Yeah, absolutely. It's a qualifying period to get your sort of your business assets taper relief. So, you need to have those options in place for at least 2 years before the date of sale. So you do not want to be scrabbling around at the last minute. 1, because it's a distraction. 2, because you'll get rubbish value. And 3, because you won't get the tax optimization on it either. So plenty of reasons why people should be having those conversations with their advisors early doors. Other questions come in around how long do I have to stick around, really? Somebody's been working in the business for 25 years at the stage of life where they really just want to do other things and sell and retire, but what are the chances that they're going to be able to exit on day one?
Yeah, I guess it all depends. I think it depends on the situation you're in. If you've already stepped back from the business, you have a management team that's been running it for the last 3 years, and all you do is pitch up to the odd board meeting and circulate the minutes afterwards, and that's your involvement, and you're a very passive owner who's now just essentially receiving an investment reward for being a shareholder, yes, then potentially you might be able to exit on day one. But bear in mind, if a lot of the consideration is coming from an earn-out, whether you'd want to or not, and wouldn't want to be part of the ability to drive that earn-out, may be questionable. However, I mean, conversely, on the other end of the spectrum, if you're active, you've got client relationships, you're driving innovation in the business, you're responsible for some of the USPs, then you're a lot more important, and you're going to be tied in probably for the entire earn-out period. But again, given the earn-out period could well be 50-60% of the total consideration you may want to be. So I think it really does depend, as in all these things. But for most founders of businesses who are active in their agencies, it is pretty unlikely they're going to be able to walk away on day one with a lump of cash and sit on the beach. I think it's much more likely they're there for the earn-out period, and actually, may also enjoy that process and may enjoy part of the synergies and seeing the business grow and driving those things through. Because a lot of founders I've met, actually do enjoy the business side of things and do enjoy their businesses, and don't necessarily want to sit on beaches, but or they might do for 3-6 months, but they'll quickly get bored. So
they think they do, and they get quickly bored, I think, the answer. And that sort of ties into another question, Dan, around generally how are sleeping partners viewed by acquirers?
Again, it depends on what those sleeping partners are bringing. Some really genuine sleeping partners, people who've been in the background for many, many years, they may well be able to get paid out if they're not adding anything to the business proposition. And again, though, there's always negotiations then, aren't there, around how much they should benefit from the earn-out if they're not sticking around, if they're getting treated differently to the other shareholders. And it will depend what they want and what the other shareholders agree and what the buyers agree to that. But then, often these sleeping partners do bring something to the party. They may bring client introductions, they may bring relationships with other businesses. So you really need to look into it before you can give a proper answer, unfortunately.
Yeah, I think that's right. But I think, you know, to your point, if they are genuinely sleeping and doing contributing absolutely nothing, my advice generally to clients is try and get them out. Try and get them out and use that 10 or 20% to incentivize some of your senior leadership team, because you're going to get a lot more value out of that than it's sitting there with people who are contributing absolutely nothing.
And often we can try and do that in the, you know, depending on where you are in the cycle. If you're not planning to sell for a couple of years, you know, you might want to do that 2 years in advance of the sale process and actually do sort of a fundraising to do that buyout if your long-term plans, if that's available as well. So yeah, it all depends on where you are and what you're trying to achieve.
Going through exactly that with one of my clients now that is taking some debt to buy the equity out, because it'll work out a lot cheaper in the long run to get some debt to buy them out for the increased value that everyone else will get. And Mike, it might be just worth bringing you in on you know, commenting on, you know, the sort of the tax challenges around trying to vary, you know, what various shareholders get. You know, in terms of, you know, can we just say the sleeping shareholders get less than the other shareholders? Can we say that some shareholders get less if they leave during the earn out versus those that stay? I mean, whilst sellers would like to be able to play around with this, it's not quite so straightforward from a tax point of view, is it?
No, and the basic principle has to be that all shareholders have to participate on the same terms, assuming they've all got the same share classes, of course. And I think any sort of divergence from that could lead HMRC to sort of argue that, say, for example, if people are sleeping partners and not working in the business get less than those that are going to be working throughout the earn-out period, that part of that extra amount the working shareholders are going to get is actually really a reward for employment. You should be liable to income tax and NIC rather than liable to capital gains tax. I'm telling you, that would not be desirable. So you do have to be very careful about things like earnouts and making sure that everyone participates in the earnout, and there are no, for example, personal performance targets or anything like that that can actually just link the payments back to employment, because it would likely generate an income tax liability. To be fair, most purchasers are aware of that particular problem, because not only does the seller not want income tax, that the buyer doesn't, because that would disincentivize the sellers from working if they were losing a lot more of their proceeds in tax. So both sides, their interests are aligned, but you do have to be careful that basically you treat all shareholders the same.
Great, thanks, Mike. Paul, what advice would you have to people who are planning for sale? And obviously, you know, you've got to present some sort of forecast to the buyer to give them an idea of what you think is achievable. But how do you go about approaching that? You know, you bullish, you conservative?
It's a very difficult thing to get right. I think there's always a tendency to be over ambitious when forecasting, and that's often exaggerated going into a sale process as sellers are wanting to demonstrate their most optimistic view of what their current year is. For clients we're advising, I'd always ask them to be as realistic as possible. It's important to show growth ideally, but the number one thing is it has to be realistic. Going through a sale process, it can be very problematic if you state a revenue number within the information memorandum, and then you get down the road with the buyer and you have to inform them that you're going to miss the numbers. It automatically puts you in the back foot. Worst case, it can derail deals completely if they have a minimum size criteria. It's also in terms of PR through the process, being able to consistently deliver good news as you are beating your forecasts is a very powerful thing to be able to do. Bearing in mind that the process can take 6 months or longer, the more that you can maintain momentum will only strengthen your bargaining position as people get to the point of deal fatigue when you're in the closing the closing elements of it. I think the other point to note as well is as a seller, with a sort of with an averaging over an earn-out period, you're still likely to receive the value for any overperformance relative to your forecast. So it's not likely you lose out on anything by having a lower number in the forecast.
One of the
I think, sorry, I was going to say, as an add-on point onto that, if you're looking at the deal process, it's important that the sellers don't get sort of completely wound up in the sale itself and take their eye off the ball, because we have seen cases, I think, where that has happened, and actually the performance of the company during the sale process has dipped. So you do need to probably, if you've got 3 or 4 founders, you probably say, well, one of them's got to take responsibility for the deal, and the other 3 have just got to focus on doing the job and keeping the business going, because it could have an impact down the road.
Yeah, I think that's right. I think, concentrating on developing your pipeline, because you've got to deliver those numbers once you've sold. And if you're not focusing on your business development throughout the process, you ain't going to hit your numbers throughout the earn-out, and you're not going to get your target deal proceeds. I mean, in terms of the bits that people dread about this process, I think due diligence is the bit that people are most nervous about. Someone coming in and crawling all over their numbers. I mean, what can we do to make that process easier, Paul?
So earlier I talked about my number one reason why processes, or we have a difficult process, being the founder being or the buyer not believing the founder will stay. I'd say the number 2 problematic reason is poor, inaccurate, or slow financial information. I'd say for any business considering a sale, it is so important to invest in your systems, invest in your processes, so that when you come to a sale process, you have you can be able to provide up-to-date financial information. There's nothing more frustrating for a buyer and for an advisor if a buyer says, okay, what are your numbers to the end of March? And then it takes 2 months for you to be able to provide that information. You need to be able to provide that information within a couple, 2-3 weeks of month end. Additionally, pipeline information is mentioned before about the PR process through a sale process. If you've got pipeline information, forecast information at your fingertips, then we can be constantly feeding in the information to the acquirer. We can be in control of that information, and we can ensure that the momentum is kept up. Then finally, when it comes to due diligence, if you've got all this information, or if you have these processes already in place, then when it comes to due diligence, it's a far simpler process for you, because the due diligence provider asks a question, and you can be confident that you have that information available at your fingertips. Where you don't have that information, that is when processes become very, very difficult, both for the selling company, but also for the due diligence provider. They'll get frustrated if the information isn't readily available, and it will just make the process a lot more fraught, and it will also get dragged out. So I would absolutely recommend investing in your financial information prior to going to market.
Yeah, and it's not just financial, is it? I mean, it's all the legal documents, client contracts, employee contracts, leases, everything like that. It's worth setting up your own remote Dropbox or whatever it is, and starting to upload and index everything in there well ahead of a sale, because again, it's just a distraction you don't need to be having when you're sort of negotiating the actual deal itself. Question coming about earnouts, actually. In terms of exploiting the acquirer's assets, so can the earnout take into account exploitation of the acquirer's assets, or only the original assets of the company being acquired?
I think that comes down to the legal negotiation. As an advisor, it'll come down to the legal position, as well as what the agreement is for how you'll be paid for the earnout. an advisor, will be pushing for you to be able to receive the maximum benefit. So if you can, if you as a company being bought are leveraging the brand and the assets of the company buying you, then we'd hope to be able to, and in most instances, you do receive the benefits of it, because it's your processes, but applied to in conjunction with the bigger group. And that's exactly the sort of behaviours that earnouts are trying to reward. Now, you do get some acquirers who will say no to some of those, and will exclude certain types, but it comes down to negotiation ultimately.
Yeah, I think that's right, and the buyer will probably try and exclude as much as they can.
Yeah, but often it's what they're trying to achieve, though, isn't it? Through the acquisition, they want to leverage on. It's not just the cost synergies that that often people get excited about, the cost synergies on an acquisition, but often really the value is in the income synergies and how the two businesses come together to create a much more robust and beneficial revenue stream. And so they want those behaviours really, and therefore there's a very good logic for arguing that they should be benefiting in the earnout as well.
Yeah, no, definitely. Questions coming here. I mean, obviously, there's a lot of companies that have taken out a lot of debt during the pandemic, receivables, loans, or they've deferred their VAT liabilities, etc. I mean, how much is this going to affect their attractiveness to a buyer? Is it going to put people off?
I don't think it'll put people off, but there could well be a price adjustment. As we said quite a while ago, businesses sold cash-free, debt-free, and a CBILS loan or significant rent deferments that are going to have to be paid back in the future, etc. They are just other forms of debt, so they'll be taken into account by a buyer. I mean, just taking out a CBILS loan, I would argue most businesses would have done that because it's a sensible thing to do. It's cheap money. There's potentially no penalties for early repayment, and at the time when you're taking out, you probably didn't have as much visibility on what the future was going to be like. So a lot of prudent businesses are taking them out. So I don't think there's an issue with taking the right actions. It actually just shows that you have a good management team who mitigate risks, in my view. However, if you've used all that money and there's a liability remaining, then that would be reflected in a price adjustment, I would think.
Thanks. I think we've probably got time for one more question before we wrap up, because we're nearly there. Questions come in. So when did you tell your clients that you're selling? It's a good one. How do you manage that whole process?
It's a very difficult part of the process, that, in truth, and it's a very good question. A lot depends on your relationship with your clients, and a lot of founders will have good relationships with their clients and may well have sounded them out about these kind of things in advance of going to a process, especially if there's a key client who's ideally none of your clients will be more than 20% of your revenue, but we all know lots of agencies where clients can be 50-60% of revenue, and if a client is going to be 50-60% of your revenue and you want to go to market, then you really need to have a good view that client will be on board with you selling and staying with the business and continuing to deliver to them before that sale process, because you're actually selling that revenue. Conversely, if all your clients are very small, you may well just leave it until the end of the deal and make an announcement. If none of them are very significant, and it's not going to scupper a deal. So it depends on your client mix, importance, and the strength of the relationships is what I'd say, which is not a very specific answer, I know.
I think I was going to say you also may have to consider any conflicts you have with clients and the buyers, because if you've got clients in the same sector, you might find that you have to one party has to disengage with one, so you do actually have to consider that sort of issue, because that can cause a problem.
Brilliant. Well, we are at 11 o'clock, so we probably should wrap. So thank you all very much for joining us, and thanks to the panel for all your expertise and answers. If anyone does want a sort of a free consultation around selling their business, whether that's now or in the future, do get in contact with either Dan or Paul, or your usual MKS partner. And we've got some really great consulting products that give you sort of one of which gives you like a traffic light system as to how you're doing on the key drivers of enterprise value, and gives you sort of the areas that you should be working on. So it gives you a real sort of sense of how sale ready you are and how much additional work and prep you need to do. So do give us a shout. Thank you very much for joining us. We will say goodbye. Thank you.
Bye.
Thank you. Goodbye.